Good morning. We'll be starting up here in just a little over 2 minutes. Of course, phone call comes in right before now. Okay. Top of the hour, Tim. Are you ready to go?
I am.
Okay. So good morning and welcome to one of our foundational Y webinars. My name is David Orr. I'm the director here at the New York LTAP Cornell Local Roads program. And we want to welcome you for those who've signed in. We will be doing some polls via pollev.com/CLRP for NYSLTAP. If you open up your chat pod, you'll be able to see that and you can get the address for that. Next slide, Tim. I'm going to go through the first three and then I'll let you get started here. We do have a few more of our upcoming webinars. Pavement maintenance next week, drainage, both surface and subsurface the week after that, and then flagging to finish out. And then after that, we'll be doing our in-person regular workshop season. We hope to see you out on the road. You do want to open up your Q&A. That's how we'll get some feedback from you in addition to the polls. The chat, you should open. It's not available for you, but that's where we're going to put messages. That's where we'll put handouts to the link to the handout, got that backwards, that you might be able to look at. It's got some good references you may want to download later on. And we may ask you to raise your hand now and then. Okay, so here's our welcome. Our instructor today is Tim Hunt. And Tim is with the Lewis County Highway Departments and it's been there about 7 months now, Tim?
About a year and a half.
Year and a half. Time flies when you have fun. You can go to the next slide too. Before that, he was for a short time with Georgetown, but he had served for a long time in Casanova, and he was actually a town board member for a while. So with that, I'm going to let Tim get started, and we'll start with some welcomes and information about who's on the session today. I'm going to go Dart.
Great. So let's first get an idea of who we're talking to today, who our audience is, town, county, village folks. If you can go to your pollev/CLRP for New York State LTAP, and you can log in and you can participate in our polls. Looks like we have quite a few town folks here, some county, some city and village. Why do I need to understand a capital budget? So the topics today are going to be on something that I think a lot of municipalities, particularly local town, village municipalities, don't do a very good job of, and that is understanding the role of capital budgeting. It's a budget that very rarely do we even do. We focus on our operating budget or our annual budget. That's the one we focus on. But we also should have a capital budget in place, and that capital budget interacts very tightly with our operating budget. And most of you know that if you don't spend enough money, for example, upgrading your fleet and your capital budget, then on your operating budget, is going to go up because repairs start to go up as your trucks get older. So if you increase your capital budget, you can control your operating budget. Now, the two of them operate together. They're very closely tied, and that's what we want to do, is we want to understand how they work together, what the role of each one of them is, and how do we manage that. And it's a little different when we're in a municipality because we don't depreciate our assets. So how do we finance them, or how do we use mechanisms that make sense for our constituents? Why can't I get the funds I need for equipment, for roads, for signs, bridges? And a lot of that has to do with how we plan for our capital budgets. So next question I have for everybody in the poll EV is, what is your role? So we have some highway supers, some commissioners, some engineers on the line. None of the above. Perfect. Maybe some board members. No, a couple administrators, and maybe just some interested folks. So excellent. Excellent. Hopefully this will be useful. And how about geographically, where we're spread out across the state? Let's see. You can just drag and drop your pin on here. Wow. Excellent. Got quite a few people from Livingston County. Shout out to the group over there. Always good participation. We got Monroe, Washington, Warren, Fulton County. And then we got Westchester, Rockland. Excellent. It's great to see everybody across the state. I appreciate it very much. All right. Our two budgets working together. The annual budget is the only budget that's required by law. It's the only one that we really have to do. And generally the only budget we worry about. Every fall, we know the schedule. We have to, put in our requests. And then in January, we start to work off of that budget that was given to us. However, your capital budget is essential to controlling your operating budget. So let's start to understand a little bit about capital budgets. There's some really good resources out there to understand that. The state comptroller's office, this is the link, puts out a manual on capital assets, and it's a very good resource guide on all of the things you need to know, right down to how do you evaluate those assets, how do you determine their lifespan, all sorts of really good information in this book. So it's worth your time to go out and take a look at that. So capital assets, what are they, first of all? They're defined as anything with a greater than 1 year lifespan. Capital assets are a tangible or intangible asset that are used in operations that have a useful life of more than 1 year. They can be land, buildings, building improvements, vehicles, machinery, equipment, sewer, water, highway infrastructure, all sorts of things, but anything with a useful life greater than 1 year. Now, we know our budget only spans a year. So if we have a cost that should be spread out over 4 or 5 years, that's really the question that we're talking about, is how do you deal with those things? And so my first question is, how many of you have a capital budget? And this one's the one I'm really curious. 67% say 71. Excellent. 33% no. Okay. I came from a town. I was a town highway superintendent for 12 years, and in a very good town. They did a great job. The board was very proactive. Excellent. But we never really did any capital plan. There was a little bit every now and then. A building project would be on the horizon and we would start to put money into a capital fund. But other than that, there was really, how it worked was, and maybe some of you are familiar with this, but we'll let our fund balance build up. And when our fund balance gets high enough, we'll use that and we'll go out and purchase a piece of capital. That was often the way capital planning got done in the town level. And I see it constantly. So it's great to see that 74% of you actually have a capital budget and how you manage that capital budget. What is your capital budget for? If you could type that in, that would be great. Is it a building? Is it a vehicle? Is it for roads? Just curious to see what everybody, that 74% of you do have capital budgets. What are they being used for? Infrastructure. Excellent. Excellent. For your roads. Equipment. Excellent. Another a good one. Highways and bridges, great. Equipment, that one seems to be a big one. Infrastructure, Yep. Great. Road, sewer, and equipment, always, equipment purchases, great. We don't really have one. We do it the way he described what was done in his town. I mean, but we don't get there, right? And that's the problem. If we fail to plan, we're going to fail. So, but yeah, that's kind of how we do it. We just use our unexpended funds until we build them up enough to be able to do something. Equipment replacement, equipment and vehicles. I'm going to focus today a little bit heavier on equipment, but I'm also going to show you the same exact concepts work for roads. They work for signs. They work for culvert pipes. But we're going to use a few examples and we're going to focus on equipment because I think it's a little more tangible and we can grab our hands around it pretty quickly. So examples of capital expenditures, obviously, and these accounts are actually right out of New York State Office of Comptroller's accounting manual. So land is account 101, and that is a capital expenditure. Buildings 102, and then they depreciate buildings into an account code of 112. Improvements other than buildings are 103, and they get depreciated into 113. Equipment 104, they get depreciated into 114. And then construction work in progress 105, they're not depreciated assets. And infrastructure 106, they get depreciated into 116. Those are the account codes and some examples of capital expenditures that are in the budgeting manual. Other capital assets 107, and they get depreciated into 117. Understanding capital budgets. Going to use a system of rules in which the government municipality passes and recognizes as regulating the actions of its members. So first of all, in my situation here, we consider not only does it have to have a lifespan of a year, but it also has to be a value greater than $5,000. And that's part of our procurement policy. They really don't want me to buy hand tools and treat them as a 10-year asset. Something like hand tools grouped together have a value of greater than 5,000, and we might have that treated that way. But usually if it's under $5,000, even if it lasts for multiple years, we just treat it as an expense. So you need to understand what your particular municipality's policies are. You need to know what the procedures are for your accounting department. When do they want you to start to treat something like an asset? Capital equipment has a defined lifespan. And I do ask this of everything that I purchase, and I do think it's an important thing to know. Whenever you're expending money, you should be asking yourself a question of how long do you expect this item to last? So if we buy a new loader for the highway department, what is its expected lifespan? What's its defined lifespan? Do we start with that position? Oftentimes we're just happy to get the new loader and we just start going along without ever trying to understand what its lifespan is. And I'll show you in the next slide why that's important. You want to know what that lifespan is. And I'm going to give you this example right here. So a plow truck, we're going to use $250,000 to buy a plow truck for the municipality. And we're going to say that this plow truck is going to last 15 years. Now we can debate whether that's 18 or 12 or 10, or maybe it should be less. I don't know. We can talk about that. And we're going to have a slide talking about how we figure out what its life expectancy is. But so if that $250,000 expense has a 15-year lifespan, should we account for all $250,000 of expense this year, or should it be divided up over the 15 years, which is $16,666? Whether you have a piece of equipment, if you buy a new piece of equipment, the very next year, oftentimes we treat it like it's not costing us anything, and that's not true. We may have expended the $250,000, but it's really $16,000 a year over its lifespan. And this is what should be budgeted, either for its replacement, or if we spend the money up front, we should be putting money away to replace it in the future. Or how are we going to start to do this in our budgets? How are we going to start to get a consistent number annually for our assets? should your budget be $250,000 for this new plow truck, or should it really be $16,666? That's the difference between a capital budget and an operating budget. Your capital budget should be $250,000. Your operating budget should be $16,000. So that's kind of the interplay that we want to start to talk about. What other costs should be considered in the purchase of that truck? It's not just $250,000, right? It depends on how we're going to go and acquire that. So we have the annual cost per piece. This is our goal. Whether it's a piece of equipment or signs, what is our annual cost per piece of equipment in your fleet? So if you have 4 plow trucks, you have 2 loaders, you should be able to say that it costs me $18,000 a year to have a plow truck in my fleet. It costs me X to have a loader. And then at the bottom, that's your total operating cost of that capital, not the purchase price, but the actual annual cost per piece. You should be able to budget a number annually for every truck in your fleet or every piece of equipment. And this is true with roads. This is true with everything that we do. So let's talk about how we get to that, how we figure out what that is. So NPV is a financial term for life cycle cost. And NPV really is a very simple term. It just means your capital cost plus your repair cost divided by your lifespan is your cost of operating that piece of equipment. So that gives you that annual budget number we were just talking about. So now I want to talk a little bit more in depth about that, because when we start talking about our capital cost, there's multiple things that are going on here.
Hey, Tim, there's a great question in the Q&A that actually fits into some of this. Should your operating budget of $16,000 take into account inflation?
Well, I think that depends on how you acquire that piece of equipment. So if you're using a capital reserve fund, I think it should. If you are using financing, I don't think it's necessary because it's going to be built into your financing. So it just depends on how you go about creating that. In the next couple slides, we'll talk a little more about that.
Well, and also, as you and I've talked, you really want to start without inflation. You can add that in later on pretty easily, but people can sometimes get lost in the inflation numbers. So, okay.
And if you put 16,666 in your operating budget for the plow truck, and you put 250 in your single year capital budget, aren't you counting it twice for this piece of equipment? It depends on once again, how you're funding your program. So some people have capital reserve funds where they would budget $16,000 a year in their operating budget, and that just gets at the end of the year transferred into a capital reserve fund for the purchase of that. And then and I think probably right now the more common scenario is where we go out and borrow the money, and then that payment for that lease payment or that bond payment is actually coming out of your operating budget. So there's multiple ways to get there. And then we're going to talk a little bit about that, how you account for that each area. So excellent. Great questions. Thank you very much. So NPV is the net present value. It is your capital cost plus your repair cost divided by the lifespan, and that equals your budget number. So let's talk a little bit about that. Capital cost. What goes into the capital cost of a piece of equipment, for example? The price of acquisition. So I go out and buy that plow truck for $250,000. Is that really my capital cost? No, there's some other pieces that go into that. If you borrow money to buy it, whatever interest you have to pay is part of your capital cost, the price of acquisition. If you do it the other way, then you do have to account for inflation. But here, interest is going to be so that's your opportunity cost, right? You're going to forego inflation by borrowing the money and buying it today, or you're going to have to deal with inflation by saving the money and buying it at a future date. That's opportunity costs that you're going to be trying to work with. So price of acquisition, any interest paid if you borrow money, minus residual value, right? So when we sell that piece of equipment, it has some value to it, whether it's to a scrap yard or depending on when we sell it. And that has to be subtracted. And that is really our capital cost. This one right here, this residual value, I see handled very inconsistently in most municipalities, right? When you get ready to dispose of a piece of equipment, where does that money go? In a lot of towns that I've been in, sometimes it goes back into general fund. It goes into unexpended fund balance. It doesn't always go back into the highway department. It might not go back and be counted against that piece of equipment at all. So by having a plan, you're going to take into account all of these things, what you acquired it for, what any acquisition costs with related to interest, minus any residual value. And if you do have a capital reserve fund, you might have interest that you earned on that money that you're saving. So there's some pluses and minuses to going each direction, and we'll talk a little bit more about how to finance that in a minute. How long you keep the piece of equipment impacts its residual value, and it also impacts your operating budget by your repair costs. I have a plow truck this morning that I just authorized to be fixed, and I've spent $23,000 on it since January 1st. So by keeping that truck too long, suddenly my repair costs, my operating costs are going up. And that is that balance between your capital budget and your operating budget. So understanding the relationship between that capital budget and that operating budget is really important. And lack of capital planning increases our operating budgets. How many people have gone into their municipality and the first thing that they've run into is they have a very old fleet. It's costing them a ton of money. They've got a lot of people who aren't out fixing roads or in fixing equipment. And they can't seem to find the money they need to fix roads because it's going into this aged fleet. That is a lack of capital planning that has overwhelmed your operating budget. So what we're talking about today is how do we take that back and help your boards and help your municipalities plan for whatever capital needs they might have to help lower the operating budget, because that's really what we're going to try to do. Repair budgets go up as the asset depreciates. Obviously, we're all aware of that, unfortunately. And that is true of all assets, right? So as a road gets older, we put more money into fixing potholes and repairing it. The same with a bridge. Any one of those assets, as they get older, they start to cost us more money. Disposal income is not consistently handled or budgeted. And that is the disposal of that piece of equipment or whatever that asset is when we get ready to get rid of it, without a plan, without it being part of the capital budget and understanding this is its defined life. And when it goes away, any disposal income is going to be applied to it. Then it gets lost and it ends up going into a general fund or unexpended fund balance and then just kind of gets missed. Often you can fund an increase in your capital budget with savings in your operating budget. And I want to take an example in actually almost every municipality I've been in, and when I've really examined their budgets, I start to look at what they're budgeting for new equipment. And then I look at their repair costs and how much we're budgeting for fixing equipment. And I say, if I had $100,000 more here and I could lower our repairs by 100,000, that would make all the difference. So you're not really going back all the time and asking for more money. Sometimes you are, but sometimes it's really about shifting where the money is getting spent. And one of the things I saw in towns oftentimes is you'd go in and ask for a large capital expenditure and there'd be a lot of debate and usually they'd say no. But what would happen is, so you kept the truck another year because you couldn't get the board to agree to let you purchase another truck. But when the truck breaks, they have to fix it because the roads won't get plowed. And that's how these budgets start to take off. Sorry about that. I got an automatic light that goes out every little while and there's no way to undo it. So often you can fund an increase in your capital budget with the savings in your operating budget, but you want to try to help them become better with that. And if you do that, if you can transfer money from your repair budget to your capital budget, get your fleet up to date or get your assets up to date, The win that you have is the labor that was fixing that stuff is now actually out fixing roads. And that's what we want to do. That's our jobs, right? Is to make the roads better, make our infrastructure better. And we need our labor out there doing that, not fixing the tools that we use to fix our roads. So that's the interplay between the capital and the operating. So let's talk about different methods, financial methods of acquiring capital equipment. Because how we build our budgets depends on what your municipality's preferred method is. And this method may change too. So one method of acquiring money for capital is bonds. And we often see that in building projects. We have a new town hall being built or a new highway garage. We'll go out and bond for that. The downside of bonds, there's legal fees that often make them very expensive. You have to have bond counsel you have to have financial audits depending on the size of the bond. And so bonds can be fairly expensive and are generally reserved for very large capital projects. That's why we see them more often on building projects and things like that. There is another form of bond, which is a short-term bond that doesn't require all of those legal fees. And that is called a SIB, a statutory installment bond. This is often an excellent way to purchase a piece of equipment. They're very much like a lease. They're just called a statutory installment bond. Then we have leases. And the problem with leases, the biggest downside with leases is we often run afoul of our procurement policy. What happens is most people, when they lease a piece of equipment, is they get the lease from the vendor. So if I'm getting a truck and I just go to that truck's leasing company and lease it, that isn't okay, because what I purchased were two separate things. I purchased a piece of equipment and I have to follow our procurement policies to buy that piece of equipment. If I buy financing, that is also something I'm purchasing and it has value and we have to follow our procurement policy. So we want to make sure if we're leasing things that we follow our procurement policy when we're doing that. And then the last way, and this used to be a very popular way, is a capital equipment fund. And every year we would take a certain amount of our operating money, 20,000, 50,000, depending on the scenario, and we would just put it into the capital equipment fund. And when that fund grew to a size large enough that we could buy a piece of equipment, we did. And that's how we fund that, is with a capital equipment fund. So the first three are borrowing money with which we pay interest. The last one is saving money, where we get paid interest until we can buy it. So there's some calculations that we can do to figure out which one is a more effective way and which one makes sense. And it's changed throughout my career. When I first got on the town board many years ago, and I'm going to age myself, we were in a period of very high inflation and very high interest rates. It made absolutely no sense to borrow money to buy a piece of equipment at that time. So we would save money, we would earn a fair amount of interest on it because interest rates were very high, and we would purchase that equipment outright. In the last 10 years, interest rates have been extremely low. And so there is a calculation you can do, and it made more sense to borrow the money and then buy the piece of equipment. So we'll walk through that in just a second. Do you have any recommendations for software to keep track of maintenance costs? Something usable in-house. Often too much what happens is we as supervisors don't see the budget and expense reports. This is the case where I work. I wholeheartedly agree with you. And I'm going to tell you, in my experience, I've used lots of different stuff to do this, because most municipal accounting software is very cumbersome. It's very hard for a highway superintendent to use. And so in the towns that I've been in, there's some really inexpensive software that's really meant for fleet management, for a guy with a small trucking firm, where you can keep track of the mileage, the maintenance costs, the repair costs, and you can put in your acquisition cost and your disposal cost, and it gives you a total cost of ownership for every piece of equipment. There's several really good, fairly inexpensive pieces of software out there. I can't think of any names off the top of my head, but I can certainly share what some of the other municipalities are using. I've got a list actually that some municipalities shared with me in a listserv on what they're using to keep track of that. But Excellent question. The other one is obviously, the old school, just keep a file folder and put every receipt for that piece in there. Your purchase, all your repair costs, and then at the end of its life cycle, you can total it all up. But the problem is it doesn't keep you abreast of what it's costing you. So as its repair costs are going up, you don't know at what point to start to get rid of that piece of equipment. So the old school way of paper is not the best, obviously. So save versus borrows. Let's talk a little bit about the different methods. What type of methods do you use to acquire capital? I'm just curious. Bonds, SIBs, leases, capital fund. 100% so far is capital fund. We utilize ARE fleet services through New York State OGS. Mike, thanks for that suggestion. Great. If people have other software that they use that they like, please type it in and we'll be glad to share it with the group. ARI fleet services from OGS. Okay, so we got 40% are using bonds, 44% bonds, 6% lease, 50% capital funds. Excellent. So let's talk about what goes into which ones you use in your municipality. Now, I'm going to be pretty straightforward with this. And I'm going to tell you that some of this comes down to knowing your board members, knowing your legislative group. There's a lot of people who have very strong feelings one way or another about whether they should be borrowing money or not. So some of this, even though there might be a good financial answer as to whether it's cheaper to borrow or to save, doesn't matter. Sometimes it's what can you get your group to agree to do. And I look at it like either way, if we can get them to at least start to think about the capital needs of our departments, then I'm willing to go down that road. So remember, borrowing money is a purchase just like a piece of equipment. The value is the interest paid, and you have to follow your procurement policies. So borrowing versus savings. When saving, the people paying for the asset may not be the ones enjoying its use. So this is a very unique argument that the comptroller's office actually brought to my attention, and it was regarding funding a water treatment project that I was involved with in our community. So what we had done is we knew that our water system was going to need upgrades. So we had started setting aside money every year. And in 10 years, there would be a fund big enough to help pay for the future upgrades of this water system. And the comptroller's office actually said, well, the problem with that is, so imagine I live in this development and I'm paying into this capital fund for the upgrade of the water system. And I live there for 10 years and I never see this water system. You don't fix it. I'm using the old one. And then I leave the area and I never got to enjoy the new water system. So you're taxing the wrong set of people. And if you borrow money, the people paying for it are the people who are using it. And I never really thought about that. So think about an elderly person who lives in your community and they're paying into a capital fund and for a new plow truck. And they leave the community and you go buy the new plow truck. They paid for something they never got to use. They never got the enjoyment of. So that's one of the things that you want to think about when you start talking about borrowing versus savings is who's paying for the asset that you're trying to purchase. The asset may be increasing in price more than the rate of interest, which is the case right now. Plow trucks on average for the last 10 years have been going up approximately 5% per year. That is varied. Some years it's been flat. Other years it's been an 8 to 10%. Some of that's been driven by emission standards or new regulations that come out. But we know that on average, inflation on equipment has been right around 5% over the long haul. And we know that interest rates have been lower than that. They've been around 2.5%, 3% for most municipalities when they borrow money to buy that asset. So that is part of the opportunity cost, right? Is it cheaper to borrow the money or to wait because the asset is actually increasing in value faster than the cost of the money? So that's a calculation that you want to do. And I'm not going to give you the formulas because they get a little complicated, but it's really a situation where you look at the interest earned minus the interest that you're going to pay versus the inflation. And that's how you figure out whether you should be leasing or borrowing money or saving money. Plow trucks have been averaging 5% increase versus interest rates around 2.5% a year. So it doesn't make sense to wait. Know your governing board. Some just won't borrow money. I have been in some small towns where the feeling was that we just don't ever borrow money. And that's, lots of things go into that. And if they just won't do it, then maybe it's time to start talking about how do we create a capital fund. Rate of return on investment versus cost of borrowing versus inflation. Those are the things that you want to start to look at is, could you earn enough return on the investment to cover the inflation of the piece that you're trying to finance? If you have a capital fund, how is it funded? Please type in your answer. I'm just curious how you guys fund your capital funds. Is it out of general fund? Is it a special tax? Is it, how do you fund it? Operating budgets? Taxes. That's it. Taxes out of the general fund. Yep. Okay. Fund balance. Okay. So at least they're setting aside some fund balance every year for purchasing new equipment. So excellent. Any excesses? Oh, I saw excesses. So at the end of the year, any money that you didn't spend in the highway department, we're going to roll into your capital equipment fund, right? That's a pretty incentivizes you not to spend money on your roads so you can actually get the equipment you need. And so there's really no money going into it. It's your own. That's an interesting one. So yeah, lots of different ways we do it. So that is a little bit about that. So planning and asset management. How do we start to get the numbers we need to go back to our boards to start to have this conversation? So creating this plan does not need to be complex. List what you are responsible for. So just start with an inventory. And in that inventory, you want to have the condition of the piece and the costs. Any information that will help you make that list. Then we have to figure out a defined lifespan of the asset that we're talking about. So those are kind of the components: our inventory, what it cost us, what's the expected lifespan. So let's talk a little bit about how we figure out the expected lifespan. So this right here is an actual plow depreciation curve for a plow truck that David Orr had created. And what you can see here is, let's put this number up here. We buy this new plow truck at $250,000, and we know that this plow truck loses value over time. And at some point, this plow truck is going to be worth scrap value. And let's say here it's 12 years. We could change this curve depending on the piece of equipment or the type of equipment that you're purchasing. And then this right here is your repair costs. We know over time that repair costs start to go up. And this one right here is not like based on a specific piece. This is just kind of a sample of what it would be. Some repair costs might be flat and then start to go up very rapidly. But we know that you're going to have a depreciating asset with increasing repair costs over time. What we also know is the absolute lowest point of ownership is right here at the bottom where these two lines meet. So if you take your cost of ownership, it is the lowest right here. So you've got your financial costs every year that you own it, it's less and less and less. But now your repair costs are coming in and starting to push that trowel back up. So wherever these two lines, the depreciation line and your repair lines cross, is where you want to start to get rid of that piece of equipment. David?
Tim, full disclosure, this chart shows up in a lot of places, and the version that's in our workshop manuals actually was first put in by Bill Mobbs, who used to be here in Tompkins County for many, many years.
Great, thank you, thank you. And I actually started to say that this was an actual, this is just kind of a general curves. This can be specifically modified for any individual piece of equipment, but this one is not. This is the general one. So,
You can actually use that for your entire fleet too, by the way, Tim. And there's a way to do that even with things with different lifespans. There's some tricks if you're really interested. I've used that technique myself when I was over at Yates County.
and David, this is also can be used for roads, for all sorts of assets, right? So
Correct. Yep.
the same thing with a road. We pave a road, we know it's here. That road is depreciating to a point where suddenly our maintenance costs start to go up and it makes sense to repave that road. And that is the same calculation we do when we start to talk about when should we repave a road, correct? So same concept is trying to figure out at what point do we, that depreciating asset start to become a liability to us. And then we've got to redo it. So I want to give you some sample plans to kind of show you a few different ideas here. So I'm going to just show you my actual one. I have a generic here, and this generic one is, I opened them up just so that they would be ready to go, and they are not. There we go. So just to give you an idea of how we would go about doing that is the first thing we would do, and this is just equipment. So,
Tim, before you get into it,
Yep.
I'm assuming we can share these.
yes, this generic one is my actual plan that I took some of the detail out so that you can use this spreadsheet for your own purposes. Yep.
So you'll get it to us and we'll post a link to it when we post it on our website.
I did. I sent it to Amanda and it's in the box and it's in the handout.
Okay, we'll get it posted. Cool.
Great. Excellent. So all we need to do is list our equipment down here. So I'm going to show you my actual one, and then I'll show you the generic one here. So this is actually a spreadsheet that I created for my own fleet right here. So I have 1, 2, 3, 4, 5, 6 mainline plow trucks and the $290,000 estimated cost right now. I have 1, 2, 3 loaders and a dozer. There is their cost. And this is the year of age that they are currently. I have a skid steer, mini excavator. I have some haul trucks. So I listed everything out. I listed out what the anticipated lifespan of these pieces are, and then what would our financial cost be for each piece. So let me show you the generic version here and show you how you would come up with this number right here. So you have a plow truck number 1, $290,000. And I created a tab over here that actually has an amortization table on it. So if you go to plow truck number 1 and you put $290,000 into that formula, it will automatically calculate that your lease payment is $63,000 a year. So then you can go back into this plan and you can create that as a number. And if you lease that for 5 years, that's what your lease payment's going to look like. So if I leased a plow truck, a loader, a skid steer, mini excavator, 2 haul trucks, that is how much money I'm going to need this year for those lease payments. And you can start to add all of your pieces in here, and you can start to come up with a good capital plan and how much you're going to need year over year over year to manage your fleet of equipment. So that's kind of how I do that. Now, I put a little tab in here by function because I wanted to demonstrate to my board that we don't have more equipment than we need. We're going to sell off everything that doesn't have a purpose, and we're going to use that as a down payment. And so oftentimes you'll see on this plow truck, this 270, I had 270 with 0% down. I could do this at 290 with 50% down, and then just put in the numbers and it will calculate my payments. If I want to go to 6 years, I just change this to 6 or 7 years. So however I want to start to do that, I can start to see how it fits. And you guys can start to do that. And then I just have different tabs. I copy this amortization tab over and over and over for every piece of equipment. So you can start to create the lease payment schedule if you're going to do leases, or if you're going to do bonding, what's your bond payment, what's the term of the bond, and then also consider what you're going to sell it for when you get rid of it. And you can build that into this as well. So that's kind of how I go about doing this and creating that sheet. So this is just a generic one that I'd be glad to share with anybody that wants to start to put one of these together. So a little bit about how you go about and do that for a piece of equipment. Fairly simple to do your fleet. So let's talk about some of the other assets that we have and what that would look like. All assets should have a capital plan. So what are some of the other assets and how do we go about doing that? Well, the big one that we take care of as highway departments are roads. And we should have a capital plan for our roads as well. And it doesn't have to be that complicated, but we also have signs, we have culverts. Anybody have any idea how many culverts they have and how many they replace a year and what that looks like as far as a capital number? That's a pretty tough one, right? Most of us don't have that specific. Same with signs. My county right now has 3,500 road signs. So if we consider a road sign maybe last 10 years on average, that means I need to replace 350 signs a year to maintain that asset. So that would be a real simple example of a sign maintenance program. What assets do you have? I just gave you some samples: roads, culverts, signs. What else is there out there? I know every community is unique and has some different assets that maybe we haven't thought of. So, see any going into the polls? I would like the slides for the grass. Absolutely. We'll make sure that the slideshow is available for everybody. Outfalls, culverts, trucks, signs, bridges, posts, facilities. Yep. Buildings. That's a big one. Often parks. Parks are a huge asset that we have in our community. Bridges. Bridges are a real big one and a really important asset that we have to manage because we don't want to get into an unsafe situation. Hydrants, drainage areas, excellent. Huge responsibility in a lot of areas. Excellent. David?
I'm just seeing what they're answering. Sometimes people throw them in the Q&A.
Oh, okay. Roads, same. Hydrants, trucks, lights and sidewalks. Yep, that's one I didn't think of. Sidewalks are a huge asset. Lighting districts often. Sometimes they're in their own districts, right? So lighting districts, sidewalk districts often.
Communication for your signals somebody put in, and beaches. Somebody actually has a beach to maintain.
Beach, yeah. Excellent. Wow. Whenever our communities need stuff done, they go to the highway departments, right? Beaches, you name it. As you know, the town I came from, we ran a weed harvester. So, pier and marina. Yeah, right. So they go, who can take care of that? And they call up the highway department and it gets to them. So, and that's the wonderful thing about this job. So let's talk about where we would start on some of these assets. I'm going to use roads as an example. It could be your marina, it could be your pier. I'm assuming that pier has a specific life expectancy and at some point has to be replaced and rebuilt. All of these things are the same, right? They're an asset with a specific life that spans many years. So an accurate inventory of that asset is the first thing we want to start with. So let's take roads, and I've gone through this a couple times, so I just want to show you how I go about it. The first thing I do when I came here to Lewis County is I need an accurate inventory of our roads. So I went to the New York State official inventory of local roads. And when you go there, obviously you get, if anybody's been there, it's got this nice little map. You click on that county. So I know there's a bunch of Livingston County folks here. You click on it and it brings up the actual document of the road inventory. I use that to create a spreadsheet that gives us the mileage, the width, if it's 1 lane or 2 lanes, whether it's asphalt or unimproved. Very helpful to get an accurate. your records should match these records. And if they don't, you need to start having a conversation with the state of New York. So that's where where I usually start to get my accurate inventory. Then we want to do a condition assessment. So I drive the roads. It doesn't have to be complicated. It can be good, fair, poor. It can be, you can use all sorts of different standards to assess your pavement conditions. But let's just start with something simple and start to get your arms around your conditions. Traffic count, if you have it available, you might want to add that. That might be really important when you start to create your asset plan, because you might not pave every road the same, or you might not treat every road the same depending on your traffic volume. Anything to help you formulate your plan. So CHIPS is often is your capital number. So in this case, you must make your plan fit the number. I'm not going to say that every community, the only amount of money that they have for their capital improvement to roads is CHIPS, but in many communities, that's true, right? The only capital money you have to pave roads is your CHIPS money. If it's not, if it's CHIPS plus town or city or village money, then take that number and that's what you've got to build your plan around. So it's just like trucks. It's just that you're going to start with a number and try to make your plan work. A plan can help you convince your board for more money. Maintenance money for pavement preservation is operating money, but it impacts your capital budget. So in roads, what I see a lot in communities is they fail to do maintenance. They don't chip seal, often don't cut shoulders, dig ditches, do the necessary maintenance that they do because they can't get CHIPS to pay for it. So they spend a lot of money paving, and then they wonder why their pavement only lasts 10 years or 12 years. So that is the interplay between your capital budget and your operating budget. And if one is failing, if your capital budget is not working, you're spending all your money paving roads and they're not lasting long enough, then maybe you need to start to look at some of your operating budget and some of the things that you're doing there. So I want to show you how I go about doing this with roads, because once you get your road inventory, I took that state inventory that I just showed you, and I created a spreadsheet, and that is literally that inventory right off of and I have the name of the road, the town with the road is in, the county route number, start stop section, and how long it is. So we're going to scroll to the bottom here, and what you're going to see in my county is I have 248 center line miles or 496 lane miles of road. So how am I going to build a plan off of that? Well, I went and created, just because I wanted to preserve this sheet as kind of the raw data. And then I started to create a plan. And I said, I want to chip seal every 6 years. I want to start to do different processes. So if I were to seal a road every 6 years, I need to seal 41.41 miles of road every year. If I want to pave, I have enough money to pave 18 miles of road a year. And if I were to ditch, I'd like to keep on the same schedule as chip sealing. So if I could ditch every section of road, I would need to ditch 41.4 miles. Doesn't mean I have to ditch the whole thing, but I have to maintain the drainage at least on a sixth of the mileage every year. Brush, shoulders, trees, and brush. So I created a plan where these are the roads we're going to seal so that I get the 41 miles. And I did it geographically so that we're not moving equipment around. So we're going to be sealing in one area, we're going to be paving in another area, we're going to be, so that's kind of how I created the plan, is exactly like equipment. I've got our assets listed here. I've got our maintenance processes plus our capital process. So paving would be our capital, sealing and ditching and pipes and shoulders. Well, pipes could be considered a capital process, but the rest of it is all maintenance. And how do these interact each other to maintain those assets on a reasonable way? So that's kind of how I did that. And I've started to do it, haven't done it completely yet, but I now have a list of all of our road signs with a condition, good, fair, poor. And I can tell you that I have 3,500 signs, and I got to figure out how to start managing that asset so that each year we budget appropriately. So 350 signs are getting upgraded every year, just on the basic assumption that it's a 10-year. So yes, you can have the road spreadsheet as well. It's going to have all my information in it, but it'll give you a great way to start, or, you know, to work off of. And I can get you the link to that road inventory as well. So yeah, that's basically, I do it for trucks, I do it for roads, I do it for signs, culvert pipes, everything that we try to do. As far as asset management, we want to have a reasonable plan, and we know how much each year we need to spend on that asset to maintain it. So that's a little bit about how you can do it with any of the assets that you have. I know I spent a little bit more time on equipment, but it's the same concept on all of the assets that we have. So let's talk a little bit about procurement policy, because once we go into this, we have to jump into how we acquire and purchase these things. Bids required. This is the state law, right? Goods and equipment over $20,000, you're required to go to bid. Public works contracts over $35,000 are required to go to bid, or you have to buy them off of a piggybacking contract. There's also your local policy that you have to follow. And then if you're using CHIPS money, you cannot do it in-house if it exceeds $350,000 a year. So some things you want to keep in mind when you're procuring things. But when we go to buy, whether it's a truck or pavement or anything else, the first thing we want to do is want to figure out what we want to purchase. What is the right piece for what we want to do? Then you want to look at the tools that you have available for you. The first one, and my go-to a lot of times, is the New York State OGS commodity contract. I love purchasing off of that. There's also the New York State OGS mini bid system. It works great. I just recently purchased a plow truck off of it. It's very easy. It was excellent. I would highly recommend using this for equipment purchases, the New York State OGS mini bids. You can piggyback. You can buy off of an existing contract from another municipality. For example, heavy equipment, Onondaga County has plow trucks on contract that we as other municipalities can use. Make sure you get a copy that it was properly let and that you keep records that it was done so. Sourcewell contracts is another example of piggybacking. You can purchase off of county contracts. You can purchase off of Sourcewell, which is actually another government entity or cooperative purchasing entity designed to allow us to piggyback off of their sourcing of goods. Other qualified government entities, it can be a county contract, it can be all sorts of other government entities. You can do an RFP if it's for professional services. You can go to bid. Don't be afraid to write a bid. Oftentimes it makes sense to do that. I tend not to go to bid when it's a very technical purchasing requirement. I tend to go to bid more on commodities. But I often look at the purchasing power of New York State as being even more than ours. So that's when you might want to look at the OGS commodity contract before you go to bid. So all sorts of different tools you can do to help procure these things, but make sure that you know the rules and that you're using those tools. We have some upcoming webinars. Again, want to remind you that on March 1st, we have pavement maintenance. March 8th, we have surface and subsurface drainage, and March 15th, we have flag. David?
So thanks, Tim. Does anybody have any questions or comments? We will be posting the spreadsheets that Tim showed today, and certainly you can always send in questions. You can either send them to us, just go to our website and send us things, just search for us, or there's the website there, or you can send an email directly to Tim at timhunt@lewiscounty.ny.gov. And good luck with your ice jams there, Tim, today.
Thank you.
And everybody stay well, stay safe, and have a great week. Hope to see you both on the web and our workshops coming up after the middle of March. Got a question for you, Mike. Moore is asking, or Monroe. Who can put the vehicle equipment on the state OGS website? I think we're talking about the surplus website, I'm assuming.
If you're talking about the mini bid, anybody can go on and do a mini bid.
Right.
If you're talking about who on the commodity contracts, that's an OGS process that they vet the commodity contracts. If you're a vendor, you can reach out to them and you can certainly put in bids when they're writing their contracts. I'm not really sure. Our comptroller or the highway super, yes, the mini bids, yes. The mini bids are awesome because you can really specify what you want. I mean, you can literally say, I want a Ford pickup truck, 4-wheel drive with, but you can put your entire spec package, you upload it. It takes about 2 seconds to do, and it creates the bid, and anybody who's eligible and has the pricing worked out with the state can then bid on it, and they bid the pricing, and within a week you've got your supplier and you're good to go. And it really is a great process. So,
and they'll alert you if you've done something that isn't kosher.
Yes, and you said our comptroller or the highway superintendent. Yes, either. I would make sure you're working with your comptroller. You have to have a document that says you're authorized to actually purchase this prior to actually going on and creating the bid. So,
and that's the key. The reason the comptroller is probably saying they have to upload it is because there has to be an authorization for a department head to make the purchase. Yep. And that's usually either done by the board or by a comptroller if you have one.
Yes. Yep.
But the department head can do it if they once they have the authorization.
Mm-hmm. Yep. Okay. Excellent.
Okay. Sounds like we've answered that question. Thanks again, Tim. Have yourself a great day, and everybody will see you around. Take care.
Have a great day.